Hello and welcome to the Westpac Macro video. I'm Sean Callow and joining me today, senior economist Matthew Hassan. Welcome, Matt.
Morning.
Now, Matt, just thinking of the housing sector to start with, and particularly prices. So obviously huge macro factors in play this year and potentially working in different directions. I mean, what's the overall trend in terms of house prices in Australia and where they might be headed?
Mm-hmm. Well, right now we're seeing pretty clear signs of a fairly stabilisation in most markets, perhaps some small gains in some of the smaller markets. So the initial price shock from the COVID pandemic and the associated recession has been milder than expected. Recall that when we first assessed the recession, we expected prices to correct nationally by about 10%. They look to have corrected by about 2.5% to 3%, and the signals are pretty clear that there's stabilisation coming through, obviously with the important exception of the Melbourne market, where the second wave lockdown has continued to see some price weakening, but even there you've got now some prospects that that market will emerge from that reopening. But certainly across the other markets, and it does follow the general theme of that the extent of the COVID pandemic shock and direct disruptions really relates back to how well each market has performed. So what we're seeing is the likes of Perth and Adelaide, where the outbreaks were very minor and brought under control very rapidly, and where they're reopening relatively quickly. Prices in those markets actually look to be seeing some slight gains. In the case of Adelaide, they're above their pre-pandemic level. In Brisbane, it's been a little bit slower, but again, it does look to be moving ahead positively slightly now. The October month to date looks to be up slightly. Sydney, we had a bit more of a wobble with the pandemic, particularly through August when Victoria went back into lockdown. But we are seeing again a clear move towards stabilisation. We look at auction markets, which are now fully functioning in Sydney. They're getting clearance rates of around 60 to 65%. That's consistent with stable prices, perhaps slight price gains. So certainly the here and now is looking reasonably positive, and that momentum looks likely to carry into year end. This week we've had updates on consumer sentiment. All of the housing related components of that update were very positive. We saw about a 10% rise in the time to buy a dwelling index nationally. We saw a 30% rise in house price expectations, obviously coming off a very deep fall. They're still down on pre-pandemic levels, but a big step in the right direction. And one thing that probably gets a little bit overlooked around housing, consumers' unemployment expectations are a big factor when it comes to purchase decisions around housing. They also improved by 14%. So that October rally in sentiment bodes well near term for the housing market. There are going to be more twists and turns in this price cycle, though, and our forecast really highlights that we do have another leg of a drag to prices that's going to come through, particularly as we move into 2021. Some of the impacts of the COVID shock to the housing market have been dampened or delayed. So firstly, we've had the large policy interventions, particularly the JobKeeper support for wages, which has slowed or dampened or nullified some of the impact by incomes. But perhaps more importantly, we have a large group of borrowers, mortgage holders, who have been on temporary home loan repayment holidays. Those deferrals are starting to roll off, and they'll progressively roll off as we get into next year. We think that process is manageable, but there will be some borrowers within that group who are unable to become current on their repayments, and that's likely to see some additional selling pressure, particularly through the middle of next year. We expect prices to soften again through that period. But as I said, we see that as a pretty manageable process. The regulators, the RBA, the lenders and the government all understand that it's in no one's interest to really be heavy-handed with dealing with these loans, and will go to great lengths to ensure that the market is not unduly impacted by distress in that segment. Gauging how big that may be, still a bit of guesswork there, but there were some figures that the RBA Financial Stability Review referred to, suggesting lenders expected about 10% of their deferred loans to experience the most difficulty. So there will be this second wave drag on prices, and there will be another sort of shaky period for the market. But right now, given what we're seeing around sentiment, what we're seeing around demand and prices, and given that the further we progress into 2021, issues around the virus are likely to recede greatly, particularly if we get a vaccine that gets rolled out widely. That longer-term impact from longer-term prospects from late next year and the following 2 years is looking very positive. We think prices will rally about 15% nationally over the following 2 years, given that all policy is going to be trying to drive a sustained above-trend growth performance, and housing is going to be part of that.
Okay. What about the investors segment? Obviously, there would have been a lot of caution initially in the pandemic, but aren't the recent numbers picking up, taking advantage of those low interest rates?
Look, it's still pretty tentative in the investor space. What we're seeing to date has really been about owner-occupiers driving the recovery in the market that we've seen today. We had some very positive housing finance data last week with another 12% surge in the value of loans in the August month, coming off a pretty good July, and that's above pre-pandemic levels. But those gains are still very much centred on owner-occupiers. First home buyers have been very active in particular, but owner-occupiers, a large part of which we saw this initial very strong refinancing flow as people moved into very low fixed rates. Investors have kind of been sidelined throughout. And I think for the investor space, that turnaround in house price expectations is pretty promising. If that continues to rally, we're back in net positive territory for price expectations. So more consumers expect prices to rise now rather than fall. That may act as a bit of a catalyst for investors, but I think there's a bit of wariness about pockets of weakness, those that are relating to the stopping and migration inflows and foreign student inflows, and a bit of an overhang of stock in parts of the rental market, and vacancy rates creeping higher in the Sydney and Melbourne markets. So the investor still looks a little bit more tentative, still at quite a weak level overall. It may gain more momentum. It'll be a key area to watch. One of the things to bear in mind of this is while there are these downside risks around housing from investors' perspective, the yields on housing investment are still well above comparative returns on deposits, on shares, and so on. And so for consumers or households that have the wherewithal to invest, the options are probably still going to be slightly in favour of residential, even with these residential property, even with these risks. So watch investors carefully the next few months. Usually it's the other way around. Usually it's the investor that really tries to get a jump start on owner-occupier demand, but this time around it's coming more off owner-occupiers instead.
Okay, just briefly on the migration. You mentioned migration there, international students there. How would you characterise the outlook for housing construction over the next year or two?
So housing construction has definitely got a rebound happening, or some positives happening. Very hard to read at the moment. I think, so firstly, what's becoming clear over the last 3 months since July is that the government's home builder scheme has driven a large rise in new home sales. So the HIA survey of home sales, mainly across detached housing, has jumped about 60% compared to pre-July levels. That's a big move. So that, recall that the scheme provides $25,000 grants to home buyers, first home buyers and upgraders, doesn't matter, on the proviso that the value of the property is below $750,000 and that you meet the caps around income. And in some markets, this has been doubled up by state schemes. WA has an additional $20,000 available for buyers, and Tasmania has something similar. So what we've seen since July, when the scheme was introduced, we've seen this jump in new home sales, of very strong new home sales figures in the likes of WA. And that does look to be providing some impetus in that detached housing segment. The wider housing construction cycle still looks a little bit weak near term. So units are still winding back. The high-rise segment in particular has been weakening for some time now, and the pandemic shock is just going to amplify that. So it's a very mixed outlook for housing construction, but you do have the beginnings of an upturn then, particularly particularly as the wider housing market starts to gain a little bit more traction, and those home builder schemes start to filter through to new construction activity. But I suspect we'll stay quite weak to start with. And there is this tension between new home building and the migration story. So Australia, prior to the pandemic, had population growth running consistently in the 1.5 to 1.7% per annum range, which was pretty strong by international standards, and that provided a basic source of demand for new housing. With the closure of our international borders, we've swung sharply on migration. In fact, we'll see a net migration outflow as we'll see more returning students and people leaving, New Zealanders into across the Tasman. We'll see a net migration outflow this year. This is something that was highlighted in the federal budget. Treasury expects population growth to be around 0.2 or 0.4 for the next couple of years. The big question, though, I think, is more about what happens as we reopen. So if we go back to those pre-pandemic growth rates for population and migration flows, or do we see a weaker population growth for a time? So, for example, do we go back to 1.5% growth, or do we go back to 1.2% growth, which is what the Treasury is counting on in their projections? And that's pretty important. That's the difference between needing 170,000 new dwellings a year and needing 130 or 100 or even lower additions to the housing stock. So if we were to go into a typical rally in new construction that we've seen in previous cycles, that runs the risk of oversupplying the market in 2 or 3 years' time, particularly if migration flows don't come back. Now, very difficult to assess. We don't know the course of the virus. We don't know what a vaccine is going to look like, whether it's viable to go back to large-scale population inflows. These are all very important and hard to answer questions. Our prior is that we should see some return towards more normal population growth in 2 or 3 years' time. But I think that's more of a slow burn question for the market. I don't think we're going, because we're weakening near term in terms of new construction. We're not in any particular danger right now. But if we pump this recovery too hard and population inflows don't come back, then we could be in a difficult situation 2 to 3 years' time. But I think for the housing market, that 2 to 3 years' time is a long way off for most people.
Yeah, fair enough. Okay, well, thanks very much. We are out of time, but I do want to remind viewers of Matt's great work on the Westpac Card Tracker Index. So there's an update coming out soon. That's a really new way of looking at very timely spending, and particularly notable state-by-state breakdown at the moment. So look out for that one. But for today, thanks very much, Matthew.
You're welcome.
And thanks everyone for watching, and we'll speak to you next week.